Hey everyone, welcome to The Explainer. I am so thrilled you're here because today we're going to untangle one of the absolute most fascinating phenomena in modern finance. We are taking a real magnifying glass to the wild, completely contradictory financial metrics of BridgeBio Pharma, ticker symbol BBIO. You know, if you've ever looked at a balance sheet and just kind of scratched your head, wondering how on earth a company can be highly prized while seemingly just hemorrhaging cash, well, you are definitely in the right place. So let's dive right in and decode this biotech paradox.
$14.47 billion. That is BridgeBio's current market capitalization. And I really want to say that with some serious energy because it is absolutely crucial to understand the sheer scale we're dealing with here. The market is looking at this company and assigning it an immense premium value. Investors are clearly seeing something really extraordinary in BridgeBio's pipeline and their market potential to justify a nearly $15 billion valuation. That is massive.
But let's slow down for a second. Negative is $724.9 million. That's right, negative. That is BridgeBio's trailing 12-month net income. Just take a second to let that really sink in. They are operating at a net loss of almost $750 million over the last year. Putting those two numbers back to back, it creates this instant cognitive dissonance. It's actually the central mystery of our explainer today. Like, how do these two numbers even exist in the exact same reality?
Section 1. The $14 billion mystery, reconciling massive valuations with staggering losses.
Section 2. Explosive growth in returns. The undeniable evidence fueling the bull case.
You know, in the world of biotechnology, traditional valuation rules often just kind of get thrown right out the window. Companies are frequently valued not on the cash they're generating today, but on the massive potential of the intellectual property and life-saving therapeutics they might deliver tomorrow. BridgeBio's yearly returns brilliantly illustrate the extreme volatility and the incredibly high reward nature of this stock. Look at that staggering 429% jump in a single year during 2023. I mean, that is a literal rocket ship. But notice the whiplash right after. A 32% drop in 2024, followed by another massive surge of nearly 179% in 2025. It perfectly captures the stomach-churning ride of biotech investing. You're basically betting on clinical trial results, FDA approvals, market adoption, all of which create these just massive swings in investor sentiment.
Now, what's really interesting here is the sheer velocity of their revenue expansion, because we aren't just talking about stock price hype anymore. There's actual, real revenue growth happening. Trailing 12-month revenue is sitting at over $500 million. But check out that third metric, a 5-year revenue compound annual growth rate of 127%. Sustaining a triple-digit growth rate over half a decade? That is exceptionally rare. This explosive top-line growth is the exact engine driving that massive 3-year total return of 425%. Honestly, this is the exact metric that literally has growth investors salivating.
Which leads us to this incredibly fascinating number, a PEG ratio of 0.60. For those who might need a quick refresher, the PEG ratio simply compares a company's price-to-earnings ratio to its growth rate, and usually a PEG under 1.0 is considered undervalued. So for a hypergrowth company like BridgeBio, this single metric suggests that despite the massive market cap we talked about, the explosive growth might actually be priced somewhat reasonably. It's a key data point the bulls always point to when defending the stock's valuation.
Section 3. The deep profitability deficit, uncovering the staggering cost of ambition.
So the crucial point here is understanding where all this $500 million in revenue is actually going, because as we established earlier, it sure isn't making its way to the bottom line. There's a real stark contrast at play here. On one side, we've got a gross profit margin of over 96%. That is phenomenal. It basically means the actual cost of producing the goods they sell is minuscule. But counter that with a net profit margin of negative 292%. This tells an incredible story. While their core product is wildly profitable to manufacture, their operating expenses, specifically massive research and development plus administrative overhead, they aren't just consuming those gains, they are completely overwhelming them. They're spending almost 3 times their revenue just to run the company and develop new drugs.
Let's break this down a bit further with a quick profitability reality check. These are deeply, deeply negative profitability ratios. A negative PE ratio of 19 just confirms the lack of earnings. But the metric I really want you to focus on is the ROIC, return on invested capital, sitting at negative 18.24%. Let me translate that into a plain-spoken narrative for you. For every single dollar of capital invested into the business right now, it is actively shrinking by over 18 cents. Actually, scratch that. It's more like they are actively destroying capital in the present day to fund the promise of massive, monopolistic returns in the future. It is a high-stakes gamble, for sure.
Section 4. Cash burn and survival. How a company bleeding capital keeps the lights on.
So with all these negative returns piling up, the natural, completely logical question is, how do they even survive month to month, right? An operation can't run on future promises alone. It needs cash, real cash to pay scientists, run clinical trials, and, just keep the lights on. The bleeding is captured perfectly by this metric. Negative $455.5 million in free cash flow over the trailing 12 months. Free cash flow is just the cash a company generates after accounting for outflows to support operations and maintain capital assets. BridgeBio is burning through nearly $500 million in cash a year. That is a blistering rate of cash burn that would put most traditional companies out of business very, very quickly.
So, how do we actually know if they're going to go bankrupt next month? Well, let me put on my financial teacher hat just for a second. We look at the current ratio. It's a liquidity metric that measures a company's ability to pay off its short-term obligations using its short-term assets. Think cash, cash equivalents, and easily liquidated assets. This is the exact metric analysts use to check a company's short-term pulse. Basically, if it's over 1, they have enough to cover their immediate debts.
And here is the reveal. BridgeBio's current ratio is 2.77. This is an absolutely critical piece of the puzzle. Despite burning nearly $500 million in free cash flow, this ratio proves they have almost 3 times the short-term assets required to cover their short-term liabilities. They've managed their capital structure, probably through stock issuances or strategic debt, to ensure they have this massive runway. So they have the war chest needed to survive the immediate future and just keep pushing that pipeline forward.
Section 5. Decoding the Biotech Paradox, the final verdict on BridgeBio's extreme metrics.
Okay, let's pull all these threads together. We've navigated the dizzying highs of their growth and the staggering depths of their cash burn to finally solve the mystery of BridgeBio Pharma's financials. And we're really left with the rocket ship versus the anchor. I want to remind you one last time of the incredible tension between these two realities. On one hand, you have astronomical, triple-digit revenue growth over a 5-year period, a true rocket ship. On the other hand, you have a heavy, pre-profitability anchor weighing the current financials down with over $700 million in trailing losses. And here's the thing, this isn't a mistake. This is exactly how hypergrowth biotech operates. The market is happily ignoring the anchor today because they truly believe the rocket ship will eventually achieve escape velocity.
Which really leaves us with a final provocative question. With explosive growth driving a $14.47 billion valuation, but deep losses burning cash, is BridgeBio's future already priced in? Have investors already paid for all the success that's yet to come, or is this just the ground floor of a future pharmaceutical giant? I want you to really think about whether the market's optimism has completely outpaced the current financial reality, or if that 0.60 PEG ratio means there's still plenty of room to run. It's a genuinely fascinating puzzle, and I hope this explainer gave you the structured insights you need to wrap your head around it. Thanks so much for joining me. Keep learning, and I'll catch you on the next one.